guys like us, not that many people know us,
Right.
right? But if we synthesize a lot of information and share a lot of ideas,
Yep.
ideally just a few really good insights might come out of that might be useful to somebody else.
Agreed. And I think a natural flow of conversation because,
Yeah.
I hate, no offense, I hate the setup of like
Yeah.
the chairs and the way,
Yeah,
whatever.
yeah.
I kind of prefer a table usually when we can. And, because it feels like we've got to have a structure to our conversation. And
Yeah.
I don't necessarily think there should be a structure to our conversation.
Exactly. And I think this like the dated idea that podcast came from is like, okay,
it's a show.
Yeah. Who's going to sit
Right.
down? Who's going to sit down and
Right.
listen to like, there's so many people doing pods. Who's
Yep.
going to listen to 2 hours of somebody
Yeah.
they've never heard from before?
Yes.
Way more effective, I think, is to just do a couple hours of this and then chop it up and find what might actually be useful within.
I think the structure of having to force a conversation gets a little bit.
I think we're aligned in
bit
that.
difficult.
Yeah,
I agree.
totally.
I agree. And we talked and we went off in a million different ways, and we'll go off in a million different other ways. And we have to say, let me introduce you. I think you start a podcast again, like you say, two people that you might not know, but they might be interesting people. It might take 10 minutes to get to anything interesting because there's this drawn out like who you are and tell us about yourself. And most of the time, it's a really boring intro.
Yeah, exactly.
So the concept of this show that we started with Deals Gone Wild, the idea of that is that inside of real estate and the real estate business and commercial real estate deals, there are really fascinating stories, and I've heard a million of them, and I've been involved in a million of them, where you've got like, it's really they're human stories. You've got crazy people out there, and I like laugh about it with you, and somebody's the seller's in prison, and there's fraud cases going. I mean, there's like really nutty, wild shit. And those things make for great stories. The really good ones do. Let's start off with that. And, it's interesting. And we'll pull people along and see the other stuff. What I've found, I'm discovering as we're starting to meet people and do these episodes and record this stuff is that we're meeting really interesting people who have a really interesting story themselves, just their life story, their business story specifically, and how they got into what they're doing and what they're doing. Yeah. And if you're interested in real estate, if you're an artist and maybe you're not interested in that, that's fine. But if you're interested in real estate, in any capacity, like you're gonna find it as interesting as I do. So that kind of hijacks it a little bit, and that's okay. Like I don't mind. I don't want to force like some model down people's throat. This is how it has to be structured. Sure. I think we should talk about the most interesting things.
Totally.
So we have a ton of interesting stuff to talk about. You have a crazy interesting story. I think your story is one of the most interesting, and there's a ton of stuff details that I don't really know yet,
sure.
Because the insurance aspect of it is something that I really want to understand. Insurance is in the word title insurance, but it's not. Title insurance isn't really. It is insurance, but it's as much as insurance. It's really it's a real estate deal, transactional. We facilitate real estate transactions, and it's very different from the P&C, property and casualty insurance business,
extremely,
or from the life and health insurance business in a few fundamental ways. And one of them primarily is what some people know, and what many people may not know is that life and health, property and casualty insurance companies usually make their money not necessarily from just premiums, pay expenses, take profits. They have to hold reserves in case of claims. They have these huge sums of money that they have to hold on to for reserves. And they get to invest that money while it sits there because there are limited reserve requirements. And that's where they make their money. And so often like life insurance companies are some of the biggest investors in large commercial real estate, either debt or equity, and getting your hands on that money. I say hands on that money, that sounds kind of devilish, but being able to tap into that as a control for debt or equity in real estate is a great way to do it. I mean, it's kind of secret sauce a little bit. So I don't know anything about your involvement. I'd love to hear more about what you do, how it involves there, and then we can go back and talk maybe about how you started.
Yeah, sure. So I guess I spend most of my time just trying to understand what's going on in the world.
Mm-hmm.
And then I sort of look for opportunities to get a really good risk reward on capital allocation across the full spectrum of available asset classes. And the manifestation of that is a private equity company that really focuses on making investments in special situations to get sort of a better than market shake on a given asset class for limited partners. And then an asset management company that really just focuses on putting ourselves in the shoes of an end client and trying to get them the best transparency and the best risk-adjusted return on investment for the exposure that they're looking for based on their objectives.
Mm-hmm.
And so I would just think of myself as a really persistent student of the world and then a capital allocator. And then as a subsidiary of that, you want to try to kind of find opportunities to get a better than market shake on those allocations.
Right.
That's kind of a summary of most of how I spend my time.
What's the engine look like that keeps because deal flow is like, right? You constantly have to look at new deals on both sides. Where's your money coming from and where's it going to? What's the engine look like?
Yeah. So deal flow with private equity, and where we're mostly concentrated is commercial real estate, is really a function of what your standards are, imputed on how much deal flow you're willing to look at and how aggressive you want to be on how good your basis is relative to market.
Mm-hmm.
So in other words, like if you're Blackstone and you have, $50 billion to deploy or whatever,
right,
you're not going to get super better than market deals for that volume. It doesn't exist.
Right.
And so you kind of have to lower your standards, and then you still do a good job for your investors. No shade on Blackstone. Actually, I have some holdings through the fund in Blackstone in different asset classes, and they're excellent. But you scale that down to, say, a boutique private equity operator.
Mm-hmm.
And the engine there is you develop all these relationships with brokers and direct owners, and you just kind of have an origination team that kind of puts their tentacles out, and you look at hundreds and hundreds of deals, and you really just try to find one deal every couple months even that just is better than what market to be in that given submarket for that given asset class.
Yeah.
Right. So, for example, right now we're in the process of buying a medical office complex in a submarket in New York. And we kind of know what medical office buildings trade for relative to tenant credit, and mix and occupancy and age of asset. And we're getting this deal something like 20-25% below what we think that's worth. And then by getting 65 or 70% leverage against that asset, that equity spread is really a 2x equity multiple within 2 or 3 years just by buying it right. Now, we spent years looking at this submarket and looking at deals and saying no to deals to find this one deal. So it's not something that necessarily works well at a really high scale, but it's a really good way to get started out.
And then you also have to bake in the cost of, like you said, you spend years looking at hundreds or maybe more deals before
Thousands
you find
of deals.
that.
We've seen several thousand deals just in the last couple of years.
It's a needle in the hay, and said no to all of them. And then there's the one thing. So it's a needle in a haystack, especially you mentioned that it's a submarket in New York. New York is probably more competitive than most other places. So that's even harder to find. You have the cost of finding those things, right? You have to carry whoever's you and whoever else is spending that time, the engine, like I say, that's out there looking for it. And then also a question is, so you got to factor that in. A question is, what have you seen over the years, over the last 5? That's a good marker since it's 2025 right now. And we all know 2020 is right. This decade's been a little weird. And then maybe before that, in terms of how often those needles actually show up,
It depends on the moment in time. Right now, if we kind of zoom into where we are at the moment, we are kind of on the way down a hill on the long duration roller coaster that is the asset markets and real estate. That's a function of rates are really high right now. That's probably the number one driver of valuation decline. Another thing that's happening is we have people leaving as a function of this sort of ramp in deportation, this ramp in efforts to balance the budget and get efficiency out of the government through spending cuts and these mass layoffs.
Global.
So so kind of like it's like the way we look at any asset class is we try to figure out what all of the levers that are sort of funneling into that asset class are and what the interplay is in the given moment and how that's likely to play out in the near term. You never know exactly where the bottom or the top of a cycle is in a market. So you basically have to decide, like, is an asset class really good long-term based on what's happening in the world? That's the first thing. And then if it is good, the second question is like, what's a good price? And so the market that we're in now is there's a lot of distress. And I think there's a lot of distress that's under the surface that's just starting to emerge.
Yeah.
So if we just kind of unpack this a little bit and go back a few years to the earlier part of your question, 2020, 2021, the COVID reaction and the liquidity pumped into the asset markets kind of initiated this ZERP era, as we called it, where rates kind of went really low. There was this ability to access a lot of capital, acquire a lot of assets at really compressed cap rates. and everybody across the stack is making fees in this process.
Right.
The title guys are doing lots of deals. The lenders are doing lots of deals.
Yeah.
The developers and the investors are taking their fees and their acquisition fees, and they're building their port. Everybody's happy, right? But then we had this runaway inflation, and then we had to do something to tame it. So we started pulling liquidity out of the market, basically. Pulling money out of the market through these mechanisms, mostly driven by the Fed unwinding balance sheet, increasing target rate. And so what ended up happening is the rates creeped up a lot. And so a 300 or 400% move in borrowing rates on real estate, which is what we've seen, translates into a huge revaluation of the asset class.
Yeah, of course.
But trickier than that is the fact that loans in real estate are all on a term, right? So most of these loans in these acquisitions are typically 5-year loans on average, sometimes a little shorter, sometimes a little longer, sometimes there's extensions involved. And what happens towards the end of these loans when you're in a bad place in the market like we're in now is the lender's kind of looking at the collateral and saying, well, when I lent you this 60 or 70%, the LTV was there with this 3% interest rate, but now that rates are 6%, the asset has repriced and maybe there's not even equity in the deal.
Yeah.
Right. And so I don't really want to take this back. It's not going to be good for my balance sheet. It's not going to be good. Maybe I can extend you out. Maybe I can give you another fake 2 or 3 or 5 years on this low rate. And I'm going to take that hit in terms of interest income, but I'm going to maintain my balance sheet. And that might be more important. So I think right now we're seeing a lot of that.
Yeah.
But you can't extend and pretend forever. So if you look at foreclosures are up over 120% by some metrics over the last 12 months in the commercial space. I think it's kind of just starting. Rates are high. The Fed has cut 100 basis points, and long rates have responded by increasing.
Yeah.
Which is a really rare thing, and it's just a testament to a lack of demand for debt at these levels on the global scale. And so I think nobody can say exactly how that resolves, but I think it's fair to say, if you're reasonably cautious, that rates are probably going to be higher for longer.
I feel like we've been talking about, I've been having this conversation for at least, what are we in 2025? By 2022, this conversation began.
Yeah.
And I think things take a lot long. First of all, cycle that you could figure a short-term debt cycle is about 7 years, give or take. I think things take a lot longer to show up than people give credit for. And I think people are hopeful. They're like, yeah, now it's going to turn around. Like this is going to happen in a year or two, and then we're going to be okay. They convince themselves that, cycles are going to move more quickly in 2 or 3 years, but that's just not reality. Because I've been having this conversation with myself and with others for, like I said, at least 2 or 3 years now. And the conversation continues to be, well, we're not, it's just beginning. It's just starting. It really hasn't shown up yet. Okay, this is it. Here it comes. Here comes the avalanche. There hasn't yet been an avalanche. In Philadelphia, for example, there's a tax abatement on building new construction in Philadelphia. And local governors decided they were going to end that tax abatement. Instead of phasing out the tax abatement over time, they decided they were going to end it as of X date. That's it. It's over. So anybody who's sitting on dirt and was planning to build over the next couple of years, and there were funds and large private and institutional money that could have sat on it for longer and planned to, but now their abatement was going to run out. So they had to go out and get their building permit. And once you get the building permit, you have to build the next year. Otherwise, right, you can't just sit on the permit either. Otherwise, the abatement will run out. You won't get your abatement. So everybody ran and built, and that created an artificial, huge spike in supply. That's a really interesting, a little niche thing. But similarly, when borrowing cost is really low for a really specific period of time, like in 2020 and 2021, for kind of artificial reasons, right? COVID and weird,
totally artificial.
Yeah.
Engineered.
Right. Engineered. Yeah. So, not free market driven, right? No. Totally engineered. And now you have, this, and plus all these other weird things that happened. People were moving all of a sudden, there was, people came to South Florida in numbers that they never did before, and other places, and left other places, moved around, had freedom that they didn't think they had before, they didn't have before. And so that creates, everybody's now building and the supply, but real estate's not a widget that you make in a factory that you pump out and you can turn it on and off very quickly. It takes years and years for these pipelines to fill and to dry up. We were looking out the window. We were like, count the cranes, and I'm sure that's a game that everybody in Miami plays. Count the cranes, it's a fun game.
Yeah, I'm gonna take you kind of deep into count the cranes.
Yeah,
I'm gonna give you a hot take that I've been spending a lot of time thinking about, and a lot of people are gonna think that I'm crazy because nobody's really talking about it yet, but I've kind of done the diligence.
Yeah.
So I own a few condos around Miami personally. I bought some of them at really good prices, and I think long term, Miami is just an excellent submarket. I mean, it's not just about COVID. There was this COVID rush, but if you look at Florida, pretty much since the advent of air conditioning, has had explosive population growth. This is not a new thing. What happened during COVID is ZERP, this massive liquidity, along with all the people moving to Miami, initiated this sort of euphoric development wave that's now playing out. And so now,
euphoric is a great word for it.
Yeah, exactly. And so now 4 or 5 years later, what we're seeing is that all of these projects are now like mid-construction, already funded, sold out or mostly sold out. Some of them are starting to get delivered. And we're seeing this kind of sputtering in the liquidity market of specifically condos and single family in Miami. And what we're seeing is longer than ever in the cycle days on the market. We're seeing listing prices drop. We're seeing inventory the highest it's been since pre-COVID. And to make matters so much more tricky, there's an unprecedented amount of inventory coming on the market over the next 2 to 3 years.
It still hasn't been.
Yeah,
it's still under construction.
So I put my sort of opportunistic private equity hat on a couple months ago, and I started talking to brokers. And brokers can be a really bad source of information in these cycles because brokers are typically motivated by transaction volume, right? It's like you talk to the brokers and the brokers are like, no, it's great. Like all these projects are sold out. Prices will go up forever. Everybody wants to come to Miami. And I'm like, how do you quantify that? And nobody can quantify that. So like I sit down with all these brokers and I'm like, yeah, but can you actually tell me how many units are coming on in the next year? Nobody knows the answer to this. So I go online, I Google like, all right, how many units are coming? It's like, we don't really know. There's estimated, it could be 2,000, it could be 10,000. I'm like, I got to figure this out. Like I live here, it's my backyard. So I start physically walking every neighborhood in the city of Miami proper.
How long does that take?
This part of the county. So it's about 450,000 people in the city of Miami proper, everywhere from Coral Gables up to Midtown, essentially, and everything in between. So I literally spent a couple months trying to figure out down to the nail every project bigger than, say, 5 or 10 units that makes a difference. Like, is it pinned? Is it coming out of the ground? Is it just announced, but it's bullshit? Is it sold? And then I basically synthesized this internal report that I built, try to figure out how much is on the market, how much is coming on. Long story short, insane amount of oversupply coming is my observation. Anything could happen. I mean, you could have a huge rush of people. So then what do you do to...
And this is just to Midtown. Let's forget about above that, which it continues for $100.
So I know that there's lots of units coming on, right? And I know that there's lots of units on the market, and I know that rates are high and it's tough. But what I don't know is how many people are coming in, right? Because if 50,000 people are moving here next year, then that could be absorbed. So that's the next part of the equation.
And it's even harder than just moving here because also you've got... This is and has always been, there's what percentage of people own here that don't live here. It's not their primary residence, but they own it. And it's not a problem that they're not occupying it.
And this is a common thing. I mean, there are times in Manhattan where you look at Manhattan and some measure would say like 30% of luxury apartments were dark. That's probably still the case, right? So that doesn't necessarily move the market. But on the whole, you got to kind of start to figure out like, what is the absorption here? Right? What are the absorption dynamics? So I got to basically something like 40 to 50,000 available units over the next couple of years. I'm giving you ballparks. I have this whole study. I could show it to you at a different time.
I would love to see it.
Yeah, I'm going to send it to you because I think you'll find it interesting. So then I start figuring out like how many people are coming. So like 40, 50,000 units, you basically need like, if you average 2.5 occupants per unit, let's be conservative, say you need at least 100,000 people. Miami's population is approximately 450,000 in the city proper.
Seems so low, by the way.
It does seem so low, right? Because most people think about the county, right? Which is much bigger, and then Miami Beach is actually separate from the city proper.
I just think about the density when I walk around and the size.
The reason I focus on the city of Miami is because that's both where the most development is going on, and it's also a really easy area to define in the context of this submarket, right? Because it's a very clear, heavy development, land by sea area in between essentially the bay and the beach. And that's where the action is. Right? So every submarket could be different, but I'm just giving you what I know. So about 5,000 people per year is the average growth of the city of Miami over the last couple of years. You would think it was a lot more.
Yeah, you'd think it was a lot more.
You would think, oh my God, every broker you talk to, everybody you talk to that's incentivized by transacting, that needs the hype is like, there's always people moving here. Not really the truth.
Yeah.
Right. So I have plus or minus 50,000 units between new stuff that's coming on. A lot of it's super luxury, expensive stuff in the next 3 years. And then I have 5,000 people a year.
Right.
And then get this. What other people are still not talking about is I start looking at the trailing 6 and 12 and 24 month sales to see, are we already in a correction maybe?
Right.
We are. I start looking at all the main buildings I know in Miami, and I start seeing 10, 15, 20, 25% reductions of clearing prices over where they were 24 months ago. Nobody's talking about it.
Yeah.
And so this is kind of the mission as someone who really cares about investing and learning about the world is you have to do the homework. Just doing that homework in one asset class is enough to build a company. It's enough to build a career, but you really have to do the homework. It's not about what people say is happening. Nobody knows what's going on. Nobody takes the time. So I took the time, and my prediction is this is my hot take on Miami. It's basically long-term, Miami is a golden asset class. There are many favorable dynamics of this area. People are going to keep moving here. People like to live here. Long-term, that's not going to change. AI is not going to change that. It may even enhance it. Short-term, there's going to be a lot of pain. There's going to be a lot of issues with market dynamics. There's going to be price is going to continue coming down, I think probably for somewhere between 12 and 24 months. And there's going to be opportunity there. And so my plan is I'm going to probably be creating some sort of a vehicle to opportunistically acquire and operate and roll up this, what I view one of the best asset classes in the world, which is A quality residential real estate in a primary market with a really good future. If you acquire a bunch of those and operate them and you kind of ride that absorption the right way at the right time, the IRRs will be incredible and the risk profile will also be really good because you'll be buying at a price that's reasonable where you have those kind of very high confidence economics that you're not going to get hurt. Even if you're buying them at the current rates, which are high, and the prices, which are low, those rents are going to be there and you're going to do well. So I think that's going to be something that I may focus on in the next couple of years at some point.
I feel like when you think of, everyone always says Miami has these super high, Florida in general has high highs and low lows. And it is this roller coaster. And if you go back decades to the 1970s or 80s, even, it's always kind of been like that, right? So people feel that way about Miami. They're kind of aware of it, but they don't want to, you don't want to live in the reality. You just look at the past and like, that's true that is the story of the state of Florida broadly in 2011 to 2016, right? Those years, it was cheap. It was like downright cheap. Like it was obvious
for very similar reasons. By the way,
very similar.
Right?
Reasons.
We had an overdevelopment wave in that 2006 to 2009 period.
Yep.
And then you had this collapse because in an asset market, when you just have 2 or 3% or 10% excess, and then those participants need to move their product.
Yep.
You can have just incredible moves in price. And I think this is something that a lot of participants don't really appreciate.
Yeah.
Right.
But when it fell hard and it felt long.
Big time.
I don't feel today that we're near the place that when you were in that lull in 2012, 11, 12, 13, 14, 15, 16, 2013, you knew stuff was cheap. You may have been worried still about demand, right? There was still a sales problem. And the reason it was still cheap was because demand was still soft, but it felt cheap, and doesn't feel cheap yet.
You bring a really interesting point, which is that in real estate markets, I think in the private markets, awareness is very late. And in the public markets, awareness tends to be early. So if you want to look at where a private asset class is going, a really good thing to do is to look at the way that the public markets are trading it.
Yeah.
Because the public markets are forward looking. So if you look at real estate and you look at real estate investment trusts that are traded publicly right now, what you'll find is that there's been a huge negative reprice over the last 2 years. So for instance, we hold a number of REITs that we acquired recently at very cheap prices, very low multiples relative to what you would think the assets would be valued at.
Right.
And that's the public market looking at that asset class and saying, rates are going to be high. There's going to be distress. I'm not willing to pay that share price today. But then you go into the private markets and there's no awareness. And the reason there's no awareness and the awareness is late is because there's no motivation. When you look at all the stakeholders in the real estate asset class, who do you have? You have brokers that want to get a deal done.
Sure.
You have attorneys that want to do more transaction volume. You have investors who want to mark to market as high as they possibly can.
And do transaction volume because that's what they do and they can't just stop.
You have lenders who need to lend. So who do you have that actually wants to get up on the soapbox and jump that things are not sustainable? Nobody, right? And so I think, but that's the opportunity in private markets. If you can kind of go in there and just extrapolate logic and reasoning
Right.
and look at where the public markets are trading, like you'll see like things are going to get worse before they get better.
Yeah.
As an investor, it's like, okay, is the asset class good? I would say, yes, it's clearly good, right? Like no matter what AI does, no matter what the government does, no matter what happens, people are still going to want to live in Miami in 10 years. More people are going to come here, like, right?
Agreed. So it's going to take time.
So
for
you
that
want the
demand to fill
asset,
out the
right? We
supply,
agree that we want the asset.
Right.
So it's just a question of price.
Yeah.
Right. And
Yeah,
so
yeah.
then the next question is, when am I going to get the best price?
Yeah.
I'm never going to catch the bottom. I'm never going to catch the top perfectly, but I can kind of, as an investor, my job is to kind of skate to where the puck is going.
Yep.
Right.
Yeah.
So just try to sort of start accumulating when you think things are sort of reaching peak distress.
Yeah.
You might lose a little bit on a couple, but you catch that wave, you average in at that best possible price. And those are the vehicles that end up doing the best if you look backwards a couple of years, every time.
You said something was an amazing segue, skate to where the puck is going. I'm going to do that in a second, but before I even get there, what do you do about, I assume you're talking about condos largely. And now you've got HOAs and condo associations to deal with. And some of those expenses, some of those fees can be really high and can destroy I mean, I've seen condos, they can't give them away because the cost of just ownership of the condo. Forget about the research that we have here in Florida, the older buildings, right?
Yeah.
There's a whole sort of conversation to go into there, a really interesting one about what happens to all of those condo developments that need to be recertified and don't have the capital reserves, and the interesting ones that are on the water. Okay, maybe there's a development play in them, but there's a lot of those that aren't really that interesting, or that it's going to be much harder to create a development play because they're not near the water. The value of the land might not be there. And now you've got a demand problem right now. Right? So those are going to be, I don't know what happens there. That's a really crazy scenario. But, if you've got a $2,000 or $3,000 or $5,000 or $10,000, a month, whatever it is, condo fee, it doesn't matter how much you get the asset for. If you can get it for free, but if you can't pay the condo and the taxes, then you're just carrying.
Yeah, no, I can tell you a lot about that.
Yeah.
I sit on the board of a condominium where I have an apartment. So as a homeowner, I'm very in the weeds on that.
Right.
So all these older buildings in Miami, particularly after this whole Surfside thing where there was this horrible thing that happened, this building collapse, the standards increased a tremendous amount to the point where you now have to actually be overly corrective.
Right.
And so
surprise, they overcorrect.
So long story short, like basically most older buildings in Miami are like ripping apart every segment of every wall in the building and spending a couple $1 million per building.
Or being forced to do that, correct?
Yeah, it's not optional.
Right.
It's not optional. And so there you have to do a number of studies to determine if your reserves are correct, if you have the right deferred maintenance accounted for. You have to do these spa projects where you essentially cut holes throughout the building to see if there's any water damage or rust underneath, and then patch up and repaint. In the case of one of the buildings that I'm involved in, it was a multi-million-dollar project. The residents are super upset. Ultimately, one of two things is going to happen.
Yeah.
Everybody's going to pony up and write the check.
Get assessed.
Or to your point, there are situations where, you got this building that's going to cost $10 million to shape up, and there's already a big loan on it. And some of these associations will terminate.
Yeah.
And so when you think about how that plays into the larger picture of things, that means that is some supply coming off of the market. But what I will tell you is that it's in small amounts, right? If you look at these older buildings, they were not built the way that these post 2005, 2006 buildings were built, right? There are not many of these 500, 1,000 unit old condominium build. We didn't have the population back then.
Okay.
It wasn't feasible to build back then. We weren't building as tall back then. So when you really think about the way that it plays into supply in the market, it doesn't make as big of a difference.
Okay.
Right? When you think about one of these towers that's 700 units a pop coming online, it would take 10 or 15 of these small buildings sometimes to just account for one of those.
Yeah.
And the reality is, most of the time, what happens in my experience and anecdotally from seeing a lot of these projects is they write the check, the residents, maybe the HOA fees go up a bit. Maybe that puts some compression on values, but that's really all that happens.
Right.
You look at an old condo building, the condo's cheaper because the HOA is higher, because that's a perpetual rent that you have to pay, just like property tax or insurance or whatever it is. So that's kind of what'll happen. But going back to our core conversation, I think the impact on this overall market that we're trying to dial in on is somewhat muted.
Yeah.
It's talked about very loudly because it's kind of a crazy thing that's going on. But if you think about just the real numbers at play,
Right.
it's kind of minuscule
Right.
in terms of the way that it will impact the overall market.
Right.
That's what we're seeing.
Yeah. There's so many variables going into it.
Yeah.
So you said skate where the puck is going. So
Yes.
that was my segue nugget that I got from that.
Yeah.
Because
But that's an important factor. It's part of the analysis.
And a guy from Florida would never use that expression. So you must be from up north.
Yeah.
Like 95% of the other people down here.
Yeah.
So tell me about up north, because I think you grew up on Long Island, right? And
yes.
yeah. And
I grew up on Long Island.
yeah.
And I was really curious as a kid. And I had a lot of ambition. Like I really wanted to make a difference. And in particular, I felt like if I could make a lot of money, I could affect change through sort of leveling the playing field for people that were important to me. I always had this innate sense that fairness was a big issue in the world.
Okay.
I don't know why, but as a kid, I have like,
it is.
have
Right.
like dream. It is, but nobody talks
Sure.
about it. So
Right.
like growing up, I would think to myself like, man, there's all these, like most people in the world don't even have what I have. I didn't have a lot. I didn't have any extra money or anything like that. And I
Right.
didn't have any family in business, but I had like food to eat and I could like go to a good public school and
Right.
I was like pretty safe. And that alone is something that like
Sure.
50 or 75% of the world
Don't
didn't have.
Yeah.
And so weirdly as a kid, I just had some sort of an intuition for that. I don't know where it came from. And so I wanted to like become resourceful and gain that freedom to actually like kind of help the people around me and affect that change.
Uh-huh.
The problem for me as a kid, and I think like the problem that most kids have is you don't know what direction to go in.
Right.
Right. So like going from where I was, and I think this is maybe helpful for people just getting started, is like I had no connections.
Mhm.
I had no money in my family. Mom's a school teacher. Dad left when I was young. He's a security guard. Like
Mhm.
no business connections. Like I asked people what to do and the advice I got was not super helpful.
Right.
Like, occasionally saw my dad, like, what do I do? He's like, go to school, always go to school, get a good job. It's like,
Right.
okay, like I don't,
Right.
what do I do with that? Go to my mom, like she's excellent, but her advice was beautiful advice. She's like, I will support you no matter what you do.
Right.
But it also wasn't informative in terms of which direction
Wasn't
to
a
go.
it was
Like just do what makes
direction.
you
Yeah,
happy, right?
yeah.
So like I dialed it down to, I guess, like 3 paths that one can take when you're at zero and you want to build something. You're at zero. There are 3 things you can do. You can educate yourself. You can learn. This is accessible to almost everybody in the world in some form or another.
Mhm.
You can find someone in a higher socioeconomic position than you are and find some way to help them, add value to them, ask them questions.
Mhm.
Or number 3, which is the most accessible today than it's ever been in history, is you can create something,
Mhm.
right? Like today, if you're a 12-year-old kid, like you can literally go on your phone and you can start writing code using an LLM, and you can start there's so many things you could do. You could build a website, you can arbitrage things. But you could do one of these 3 things.
Yeah.
And these are 3 things that you can essentially do with nothing or close to nothing. I didn't have, I guess, like a lot of creativity, and I didn't have good rote memory, so I wasn't like good at programming as a kid. And so I went the route of self-education and trying to help other people.
Okay.
And the self-education part was specifically focused in reading books in self-help and how to build businesses and how to make investments.
Did you think of it in these terms when you were a kid, or was it later that you look back and realized like this? I mean, you're right, obviously, about these things, but these are the options, and you've analyzed it after the fact.
The way that it happened for me was I had a lot of false starts that I learned lessons from.
Mhm.
So I would just go around asking people questions. And I eventually like asked this guy on the street, literally when I was 14 years old,
Right.
about how he got this new motorcycle. And he was this guy on Wall Street.
Yeah.
Ended up with a paid internship on Wall Street when I was 15,
Okay.
working in institutional sales at this investment bank. But false start. Why? Because this was 2007. And then
okay. All right.
great financial. I was like the youngest guy in the office, like buying steak sandwiches and
Yeah.
building spreadsheets and stuff, and like taking the subway.
You had a year of that before.
I had a
it
year
all
of
fell
that,
apart.
and then it was like you
Right.
can keep working here, but we can't pay you anymore, which was
Right.
totally logical. So like then I
But
went
it gave you a taste of investment banking. There's something I bet you
Yeah.
got out of that experience.
yeah.
that,
I
you
always
know,
had this sense that,
opened your
and this
eyes.
is still true to this day, is that if you force yourself to learn things ahead of where you should be relative to your age group,
Yeah.
okay,
Yeah.
if you just learn that 1% more, you end up that compounds in an incredible way,
Right.
just the same way that capital allocation can. So for me, I knew that by learning about finance and investments at 15, that I would suddenly sort of jump skip ahead of where almost anybody else on the planet was in that
Yeah.
area of expertise.
Mm-hmm.
And it turned out to be true. And so, I made close to $0 working on Wall Street,
Right.
but just understanding the difference between a stock and a bond and an option and studying Series 7
Yep.
and just having a foundational knowledge at 15 was this huge step up.
Yeah.
And that led me into my next opportunity, which was asking questions to people. I met somebody at the gym who was an attorney.
Mm-hmm.
I ended up working for their law firm, organizing their files and helping manage their office. And this was when I was 17 years old. And so then by the time I was 18, 19, I had developed sort of a skill set in organization and management and some legal background. And I had my investment expertise, and I'd spent 5 years reading books on Benjamin Graham and Warren Buffett and asset valuation. So I was like a 19-year-old kid, but I still didn't have like a thing to do with it.
Right.
And that's another problem is like, you can educate yourself, but you have to realize it's never going to directly manifest into something when you think it is. It's just going to accumulate. And then when the opportunity comes, you're going to be ready for
this stuff.
So anyway, long story short, I ended up like finding a unique situation where I was able to take over a big property for a family office and manage that property, which was basically like applying this organizational skill set, this asset management skill set. And then I built this property management company to put myself through school, essentially.
Okay.
So I study economics and I'm managing some property. And I didn't have enough money yet to like really make investments, but I was still reading my books and tracking markets and had like a trial portfolio.
Mm-hmm.
And then I saved up enough money by the time I was 22 to buy a small shitty building somewhere, but not in a primary market.
Right.
So it's like, what do I do? And so I'm like looking at deals everywhere, and I go back to Binghamton, which was where I went to college.
Okay.
And I see like this special situation, as it were, right? Like the university is saying they're going to add 5,000 more students. There's this little downtown center that could be maybe 1,000 or 2,000 bedrooms max. And you could still get these really nice brick row buildings for next to nothing because you got like basically like bars on the bottom and they're vacant upstairs or they're squatters or whatever.
Right.
So I basically reached out to 50 different landlords in that downtown center.
Yeah.
And I made offers to damn near every single one of them.
Right.
And I took the highest confidence basis, like the building that I thought I was getting cheapest relative to intrinsic value, where I was the least probability of losing the little money that I had.
Right.
And I had to bet it all on that building.
Right.
Because when you're just getting started, like you don't have the option to build a portfolio.
Right.
I had like $150,000 or $200,000 to my name.
Right.
I put that all in this building.
No investors, you just bought it yourself.
No, and bought it for $600,000. Like got the guy, the old owner, to hold some paper for me. So I put like $150,000 down. Then I put 50 into the building, and it had to work, but it did.
Right.
And I used that as a model. Like now I had the expertise, but I also had some track.
Yeah.
And so I used that as a model to sort of syndicate these small building acquisitions in this downtown Binghamton area.
Right.
And the deals were small, but the IRRs were really high relative to other markets. And so they were kind of attractive, and the basis was good because you're buying these buildings for $20 or $30 or $40 a square foot, literally.
Right.
And then you go like down to Manhattan and the rents were $40 a square foot. Right. So it was a good thing to do from where I stood at that point.
And you had inherent demand because of this university.
Students were coming in, the rents were going up. And so that was good for a few years. But then ultimately you run into this wall where like you can only get so much scale and you can only build so much organization when you're buying these small buildings for a couple $100,000.
Right.
And the market was small, and the market was also really dependent on this one institution.
Right.
And that's the tricky thing about submarkets, which we could go into separately. But you really want to be in these primary markets where there's enough density where you're going to de-risk that absorption over the long term.
Yeah.
So what I did was I found I found some partners who were more skilled at raising money, had more capital connections, were really great originators, and we kind of teamed up my operation, my execution, their cap intro, and we started buying assets that were a little more meaningful in scale.
Right.
And so that was essentially the way that Candor was born.
Got it. And then you just started looking for you got yourself out of Binghamton. It was not as
I still have a few buildings in Binghamton.
I'm sure. Yeah. And it wasn't as geographically focused, I would imagine then, right? Now you're just looking for assets. So now what do you do? Because now you can kind of go anywhere.
Yeah. So what you do is you take the same methodology in real estate investment as you do to any other asset class. Like I just want to find something that I can get for cheaper than what it's worth.
Sure.
Right. And so you start looking at submarkets where, for me, it was good because we had vertical integration. So I already had the background and the infrastructure to manage the assets, right? So I could kind of unlock some value and some margin there. And so me and my partners would just look at hundreds and hundreds of deals, and we would just scrutinize every single one and just try to find that diamond in the rough. And it's like, it wasn't glamorous and it wasn't sexy. It's just a grind, but once in a while you just get a deal that's kind of a no-brainer.
Right.
So a lot of the deals that we bought early on were dialysis centers, for example, mostly DaVita anchored, right?
Sure.
So like DaVitas are interesting because there's so many of them, and it's kind of a long-term durable asset class. And sometimes you can get them with these 10 or 15 year leases.
Yeah.
A lot of these small single use retail type things. And you got a credit tenant, and you kind of can determine what the market is. Like the market at that time was like a 6 cap market, 5.5 cap market, depending on what the term was on the lease.
Right.
So when we would find one that was like a 7 cap or a 7.5 cap for some reason that we could get at that elevated rate, it was almost arbitrage like.
Sure.
Right. And so it was easy to raise the money from LPs. It was easy to put the partnership together.
Just mispriced, just like a broker would misprice this
Yeah,
thing.
and there are a lot of reasons that this happens, right? Sometimes someone just wants to sell really fast. Sometimes it's an inherited asset, and the person who inherited it is not in the business, and they don't really know how to market it to get the best price discovery. Sometimes it's a family that's fighting, and there's 20 different kids that own the building. Yeah, these situations really happen. I think there's like kind of this negative connotation that's put on by big institutions, like, oh, these cheap deals don't exist. Like the market is so transparent. I mean, from my experience, it's not true. It's just, it doesn't work for major scale.
Right.
Nobody's right or wrong in what they do. It's just like, if you need to deploy $1 billion tomorrow, like, I don't know if I'm able to get you that below market, but if you want to just deploy $10 million and you want to get a better shake, it's very doable.
You also have to really understand I say in any business outside of real estate, like, understand your audience is the most important thing, period, the end. There's nothing else like that. You have to live and breathe. You have to be your audience almost first. Like, that's the best way to be in business.
Exactly.
So like what you're describing, you might look at 1,000 deals, but if you're not really super duper familiar with, not just retail, but the market geographically, in your case, in this case we're talking about, DaVita, and they're like who they are as a tenant, what they look for, what's valuable, what their rents are, what their longevity, like all of it. I mean, there's a million components. Then you're going to come across a deal and you might think, why is it so cheap? What am I missing? What don't I know? Like it's Warren Buffett has a thing where I forget what the quote is. I'm going to screw it up, but
he does.
It's only risky if you don't know what you're doing, something like that.
The more pertinent quote is, price is what you pay, value is what you get.
Right.
And I've always taken that to heart.
Yeah.
Big student of Warren. Actually also a student of Warren's teacher, whose name was Benjamin Graham. Benjamin Graham he wrote The Intelligent Investor, which was essentially the Bible that a lot of us value guys go on to determine like how to value assets. Everything from like a debt instrument to a company to a real estate asset to a commodity, right? Price is what you pay, value is what you get. And then Charlie Munger has a better saying. It's my favorite of the two, and it really speaks to kind of long-term mindset and investing. And the quote is, "We just keep swimming and let the tide do its thing."
Yeah.
And I think it's really important in today's market where there's so much dispersion and there's so much more information coming at everybody, and there's so much more volatility, to just take a step back and say, no, the job is just to have a really good scheme of assets that will do well long-term relative to what's going on in the world.
Right.
That's the job.
It's relative to what's going on in the world, which means that it's not total. Like, to me, that Charlie Munger quote that you just is more like, it's more like just stay steadfast, continue to like believe in what you know and what you understand, because the circumstances will change and the value of those assets will change relative to those circumstances.
Yes.
Like Warren's also known for telling for saying out to the world, just, dollar cost average your savings and just keep chipping away and do that forever. He's also not known for doing that at all, right? He hoards cash and buys the market when market's low, right? He takes advantage. He's advantageous as he should be, and like he does it the right way. So he doesn't act the way he necessarily says. But to me, that's like let your emotions drag you around like they're dragging everybody else around.
Yes.
Let everybody else get drug around and recognize that what the difference between emotional and reality.
Yeah, it's interesting. Like being a good investor has much more to do with emotional discipline than intelligence or information.
Much more.
This is something that's really hard for people to get their heads around.
Sure.
Because everybody feels like being a good investor is always about having some really complex insight that nobody else has and having some edge. It's not really true.
Right.
When you look at investments that have done well over the very long term and you kind of hindsight, you see that it really was just buying assets that made sense at reasonable prices and holding on to them through all different types of directionality.
Yep. Yeah.
Right.
Yeah.
That's really important, I think.
Yeah. So we're at this point in your story. I still want to hear about the insurance business. We started.
Yes. Like, how do I get into insurance? It's kind of indirect. So it's more on just asking questions and trying to help where you can without an expectation. This goes all the way back to the methodology of like when you don't have anything, you should just be asking people questions and seeing how you can add value. It's the same thing when you have a successful business, right? It never changes. That principle works. And so what I was doing was I was getting insurance on all these small buildings that I was buying in upstate New York, right? At that time. And there was a small insurance company in upstate New York that was wondering why like a 26-year-old was buying 35 buildings in a beat up city in upstate New York, which was reasonable. And so the president of the company ended up agreeing to do a lunch with me, and one of the insurance brokers introduced us. And I just started kind of spitballing ideas like, okay, you're a small insurance company. Like, how do you do your underwriting? How do you do your business development? How do you originate? How do you kind of like figure out like what your vintages look like in terms of your loss? And it was a similar situation where this was a person that could benefit from the curiosity and the spitballing. And there was a seat opening up on the board, and the average age on the board of that insurance company.
Not 26 years old.
It was like, this excellent guy got me an interview with the committee. Right. And it's like, I think I was probably the youngest person on the board by like 20 or 30 years of age. I'm sure. But I ended up serving on the board, and over time, you serve on a board, and the board's job in any company or any association is basically you look at the business, you look at the financials, you look at the management, and you basically are deciding if you have the right management in place and you have the right strategy in place. And so in doing this, you learn a lot about the business, right? So I learned a lot about where insurance companies make their money, where they don't make their money, how all the different vendors and line items funnel into the sort of economic picture of what an insurance company does. And as we were talking about before, insurance companies, as they get larger, the really good ones offer a really compelling rate to the consumer, and they make their money by essentially investing their reserves or the float. And in the case of this growing insurance company, it had never had a huge amount of reserves. And so the asset management that it had was it was mediocre. It wasn't terrible. It was just kind of many intermediaries, many layers of expense, ultimately exposure to very basic assets like just credit rated bonds for the most part.
They didn't have enough scale to control it themselves.
And it struck me like I kind of just applied first principles and ground truth to this portfolio, and I thought to myself, well, if you take an investment portfolio with a pretty simple objective, and you cut out all the middlemen and you cut out all the extra fees, and you apply just a little bit of a sense of what's happening in the world to it, you can unlock a lot of value. You can unlock, sometimes a couple hundred basis points in a portfolio just by doing that. I said, you know what? If I can give these guys better service, if I can charge them lower fees, this is what I love to do anyway. I'm an investor by trade, right? And so I took over the assets of this company, and it's been really good. It's been really, really good. We've been beating the industry average metrics. As insurance companies, you have to publish everything publicly. There has to be transparency. And so we've been beating the averages by a really big margin over the last couple of years. And so now I'm thinking about maybe having conversations with other small, medium-sized insurers who might have a similar desire to optimize their sort of transparency and their fee structure and their asset allocation scheme. And it's something I really enjoy doing.
I feel like there's probably, I don't know how many small to medium-sized insurers there are out there.
There's a lot of them.
I would imagine
a lot more than you might think.
And they're probably dusty. I mean, there's probably a lot. I feel like that industry and especially the small to they're older companies. If you're small to medium sized, you're not a newer. And I feel like there's a lot of probably dusty decision making.
Yeah, I want to touch on this. I think part of what I think the world would benefit from is everybody who's young right now, not everybody, but a lot of people who are young think that they need to build some new technology or some AI or something incredible and take some massive shot to make a difference in the world.
Right.
But the reality is, if you just take the time to look at a lot of these industries that are kind of legacy industries, been around for a long time, you can find so many inefficiencies, just basic inefficiencies within the organizational structure, within the way that they do certain things. There's so much opportunity to just work on that. And you can unlock so much value for consumers and you can unlock so much value to those companies, those companies by doing that kind of thing. And so insurance is like a perfect example of that. You know, most insurance companies, they have a lot of processes that they shouldn't have, that should be deleted at this point. They have asset management that's based on a framework of looking at the world from like literally 100 years ago. Now there are constraints, right? Like as an asset manager in the insurance space, you can't say like, okay, why don't we just go 100% long S&P? It doesn't work that way, right? You do have to be very low volatility. You have to respect the capital you're managing. Float. You have to be there for the policyholders, right? There's regulations you have to comply with, but it doesn't mean that you have to do a poor job, which is what a lot of the space does. Like, it doesn't mean that you have to just put 80% of the money in, you know, long duration treasuries, which by the way, lost you a lot of money if you own those. Or less. Like treasuries are only de-risked when they're structured on like the right tenor and the right environment. So the point is, you know, even within the confines of being mostly in fixed income and the confines of having to be liquid, you can really do a lot better for your client, and you could put yourself in the shoes of your client and unlock a lot of value. And these small, medium-sized insurers know, if they're lucky enough to even get some velocity, they realize, you know, last year the insurance company I'm referencing made more money on the asset portfolio than they made on their operating profit. Right. Wow. And so that's you know, most of these companies, and not just insurance companies, you know, endowments, small companies that have a good amount of reserves, they just kind of toss them to some firm. They don't really look what's going on. They don't have anybody at the company that really takes time to understand this. And they overlook the fact that like this pile of assets could actually be more value than the operating part of your company. And so this is something that I think there's an opportunity for really thoughtful people that care a lot about asset management and looking at the world to kind of like discuss ideas with those types of companies and see if there's some value that could be added there.
That's true. You know, this whole concept of, you know, quote unquote boring businesses, as you started to talk about, you know, that has become a little bit buzzy too out in the world. You know,
everything's buzzy right now.
Everything's buzzy, which I think it's a good thing that the idea of boring businesses has become buzzy. I think once things become buzzy, it gets a little, you know, a little eye rolly, and you get people that come out that are just selling the sizzle of, you can create sizzle out of anything. And so they've created sizzle out of the idea of boring businesses. But I mean, you know, going way off of the topic of insurance companies and managing their assets, I mean, the trades have always been a very, very strong business. You know, plumbing and HVAC businesses. HVAC is kind of eaten up by private equity, but roofing businesses, these are good businesses. And if you run them well as businesses, most people in those businesses don't run them very well as businesses. So there's, you know, then there's almost unlimited demand. And I think that, talk about long-term, like the long-term demand for building and trades and maintenance of building is, again, it's almost unlimited, I think. And it's very, very attractive, like in the long term. I think we still have a housing shortage. I mean, there's just more people. There's only ever more people, you know, on Earth. Like that's the one constant, right, that you can pretty much count on, is that, you know, especially now, like we've got to, you know, there's 7 billion people on Earth, and then there's 8 billion, and I don't know how many there are right now, but it's moving fast.
That's actually a nuanced situation now, because we do have a number of large populations that are losing people. So one thing that I think a lot about is population decline and how that impacts these asset markets.
That China is losing people, I know.
So China's losing people. I think the worst situation in terms of developed nations is Japan. Japan is now losing, I think, approximately 1 million people a year.
That's crazy.
And this is a really big issue. And what you're seeing, and this is a good case study for anybody who cares about real estate as an asset class, is I had a sense that Japan started losing all these people a few years ago. I thought the real estate market would just collapse. I mean, you know, like, again, as we talked about, if you're in a market like real estate, if you even have a 1 or 2% oversupply, it can have huge implications, because then all those people just need to get sold. They need to get rented, and they will drop to whatever price. It didn't happen that way in Japan.
Mm-hmm.
What ended up happening in Japan was the tertiary markets really collapsed. I mean, you can basically get a building for free in a lot of parts of Japan right now.
Right.
But if you look at Tokyo, all-time highs,
Yeah.
population growth. Why is that? So you start losing population as a country, and what actually happens is everything doesn't collapse in unison. People flock from those tertiary markets that are really struggling, those more rural areas, and they say, okay, now is time to move to the city center where there's density, where there's population.
Jobs.
And so there's this very counterintuitive thing that happens where the primary markets may actually benefit from a reduction in population. This ties back to this very important idea in real estate, which turns out to be true. And a lot of seasoned guys will tell you this, which is that these primary markets long-term are where you want to be.
Yeah.
And that's something that is tough because when you're just getting started and you don't have scale capital, the primary markets can be very expensive. Right. And so you got to do something else to kind of side door, backdoor your way into getting into those primary markets ultimately.
Yeah. That is super interesting. I mean, I know things like that have been seen in the United States too.
Yeah.
People are leaving rural America. I don't know at what rate that's happening now versus 30 years ago or 10 years ago.
Yeah. I mean, I can give you an approximation because being in some of these secondary and tertiary markets, I've seen that it's not a rapid decline. It's sort of a slow decay. So like a small city with 50,000 people is probably losing anywhere from, 100 to 400 people a year.
Right.
But this has a big impact.
Sure.
Right. And you can't really build anything new. And, again, that little bit of oversupply tends to have a pretty dramatic effect. And then it has a cascading effect where now capital participants, investors look at those markets and they say, well, I can't buy somewhere where the population is coming down.
Right.
But there's interesting opportunities there sometimes because sometimes the prices get so low that you're getting such good economics on the acquisition that you can actually look down the line and say, I don't care if the population falls. If I'm buying at a great asset at a 12 or 13% cap rate and I'm going to have all my money out in 3 or 4 years and then, it's a tricky trade to make. I'm not saying that's a good trade, but I'm saying everything at a certain price can make sense.
And probably the best assets in that kind of situation matter, right? And then you want the absolute best assets, so you're getting.
Yeah, like I'll give you an example. Like let's say let's say you could get a DaVita dialysis center in a city that has a slightly declining population, but you can buy the dialysis center at an 8 or 9% cap rate, and you can lever it at 5 or 6%. And you can get non-recourse financing, and there's a 15-year lease with a credit tenant.
Right.
Or like you kind of know that pound for pound, you still have to make the argument of like what's the capital appreciation element of that, and you have to get it really cheap if you think it's going to decline. But it also might not decline. Right. 15 years from now, that town might still need that dialysis. Like certain businesses, there's no real path for innovation to take them away.
Right.
And so that kind of funnels into the way that we underwrite each asset. And the use case.
I was kind of start to head toward wrapping up, and my question was: we've talked about Miami, we've talked about upstate New York, we talked about small markets and large. We've talked about not only real estate markets, but it sounds like there's a lot of things. I don't know if there's an answer to this question. Is there one thing? Is there one thing that really turns you on that's out there that's standing out more now than others?
As a macro allocator of capital, you always want to kind of have your eyes on all the different asset classes and how they're performing, right? You have to you can only say that one asset class is a good proposition if you know how it's probable to perform relative to the other available asset classes. There are a couple different things at any given time that I'm kind of bullish on. One sort of bullish stance that I have is China, actually. China is an area where there's been a huge decline in equities over the last couple of years. And there's been this kind of, I think, narrative that's developed that there's going to be this kind of great fragmentation and, China is going to be uninvestable. If you really look for truth, what you find in China is that they're an extremely developed, innovative country. They're the only country that even comes close to the United States in terms of their GDP and their trajectory as a global power. The probability is that we're just going to have to coexist. I mean, anything can happen, but you have to coexist. And so what does that mean? It means that China will be a developed market too. It kind of already is. Anybody that goes to China will tell you that it's incredibly advanced. China by nature is not very acquisitive. They're not very aggressive. Some people would say the contrary, but if you look at the data, it's just, they're not really interested in aggression. They're kind of interested in building themselves up.
Right.
What does this mean for markets, right? Chinese stock market some of the best companies in China we've seen trade in the single digits price to earnings ratios. These are like excellent companies that are growing at 30 or 40 or 50% a year and have scale. You look at comparables in the United States and you'd see price to earnings ratios of 29 or 35 or 40 or 50.
Yeah.
And so there was this big dislocation. And again, it's not like you go all in on China, but you say like, okay, if I shift 20% of my portfolio to like the best companies in China, the risk reward on that is really good.
Right.
And so that was a trade that we made towards the end of last year. And so far this year, I mean, we don't ever think short term, but so far it's been, there has been some movement in the right direction on that. And so I think that's one take I have in the public markets. Another take that we have is there's a huge amount of dispersion in public markets right now. So a lot of times when people look at public markets, they just think like, well, what is the earnings multiple of, say, like the index that I think about, like the SP 500 is the most commonly used one, relative to history. And right now it looks really expensive. SP multiples right now are like bouncing between, say, 28 and 30, which is very high historically. But there are a lot of things that are in index multiples that are missing from the analysis. So if you look at multiples in equities markets, you have to ask other questions like, the multiple's high, but what are profit margins like? How are they trending? How much is earnings growth trending? And so you start to kind of go under the hood and you start to see two things. You start to see that on the earnings relative to multiples and growth standpoint, a lot of these bigger companies that are kind of driving index values are growing very quickly. They have very good margins. They're growing earnings very quickly. And so this makes those multiples look a little bit less expensive. That's the first thing. The second thing, which is even more interesting, is what we call dispersion in the equities markets. So a lot of times when any asset market is really heated up, you kind of see all the assets trading at an elevated value. And so it's kind of dangerous to be in any of them. What we've seen in the cycle the last couple of years is we've seen kind of the sexy stocks, like the tech stocks, the AI connotation stocks, go through the roof. And some of them are trading at just ridiculous multiples that make no sense even in 10 years. But then you have other sides of the market where you have like really great companies in the market that are trading at lower valuations fundamentally than they were trading at 5 or 6 years ago. So you got to kind of look at that as an investor and say like, well, yeah, there's liquidity risk across the stack. Like if there's a huge market drawdown, like everything gets hit, right? Why? Because capital is flowing out of this market, right? And that's going to just basically put a lot of pressure on bids, right? But you can't time it perfectly. So are you better off kind of just selectively allocating to companies that are really good value for what they are instead of investing in the indices maybe? Is that an approach that's going to get you a better risk reward? We think it is. And so we're doing kind of a hybrid of, in the equities market, we think you want to be selectively in companies that are really good value for what they are. And then you want to have also a good amount of liquidity, assuming that things are kind of late cycle potentially. Like Buffett right now has a record cash pile in Berkshire of over $300 billion. He also has a really big equity portfolio. He doesn't dump the equity portfolio. He stays in companies that are high conviction. And this is throughout history, if you look at any cycle, right? Stays in companies that are high conviction, takes the foot off the gas a little bit, accumulates cash. And then when that cycle starts to bottom out, when sentiment's at a real low and multiples are a little compressed, then he puts the pedal down on those companies he really likes. And that's the alpha. When you get that company, you're holding that company, it goes down another 20, 30%, 40% even, but you have a position, now you get to double or triple that position. Then you get the next leg up. And that's where the money is really made in equities for those long-term investors that have outperformed the indices. So that's the take on equities.
Going back to what we talked about earlier, the Buffett quote, or what Buffett does versus what he says he does. And what we talked about throughout this entire thing, you're not investing in markets. You have to invest in particular assets, right? And companies that make sense, not necessarily in an index, because that's where.
Well, I'll tell you why Warren says what he says. And again, like hero of mine. And I think if you look at the way that Warren is, he has very simple values and he cares a lot about people and the consumer, and he has a huge amount of respect for capital. And so he looks at a community that's looking to him for advice. And the reality is that picking stocks is incredibly difficult.
Absolutely.
Right? Like for me personally,
most people are not going to be able to make
I'm okay at it maybe based on my track record. And I don't go to sports games. I don't have hobbies. I mean,
Right.
it's like my,
This is
I'm
your
like,
hobby.
I'm on the
Right.
couch at night, you know, like my friends are at
Yeah.
bars or whatever. And I'm on the couch at night and I'm like literally just re-looking at the same position I've had in one segment of the portfolio, re-underwriting it like for the 50th time this year.
Right.
It's not an easy game.
Yeah.
And
It's
so
a game you have to be obsessed with.
right. So
obviously.
if you're a folklore hero
Right.
like Warren Buffett and you have people looking to you for advice,
Yeah, of course.
you give them the advice that you think is least likely to be harmful to them.
Yeah, I think that's
Reality is American ingenuity has tended to prevail. American industry has tended to prevail. And if you invested in an S&P 500, you
you'd be
got
better
better
off.
returns than almost every other asset class.
Right.
So the book he talks is he's being honest. He's saying, if you don't want to spend 100 hours a week and 15 or 20 years getting good at this and make your whole life about it, or you don't have the capacity to do that,
Right.
just go in the index. Don't invest
No,
in
he's
it.
right,
Don't
and
invest in
you're
a
right.
2 and 20 manager who's
Yeah,
going to
yeah.
underperform the market and lose all your money. It's actually really good advice that a lot of people
agreed.
still don't take.
Agreed. Don't gamble. Just put it on the house. And the house will
But
win
again, at the
eventually.
same time, like if you're a sharp like
Right.
Warren is,
Right.
your strategy is you're swimming with the tide.
Yep.
Right. You're leaning into those cycles. You're adding allocations to companies that you feel really good about. You're accumulating cash when you should be accumulating cash. You're deploying when you should be deploying when you're getting those really good prices. And you're rebalancing. And that's what he's always done.
Yeah.
Right. So that's kind of the nuance there.
No, I
think.
agree. I agree with that 100%. So buy low and sell high is basically the message of this entire thing. All right.
It is though. I mean, it's it's like, isn't it funny? Like the way that we have really nuanced ways of going into things and there is complexity in the world, but then a lot of things like do come down to a pretty simple.
Yeah. At the end of the day, it is simple. It's simple, but it's not so simple to get
it is.
there.
It
It's
is
not so simple to
the
find
world is a very much a buy low, sell high world.
Yep. Absolutely.
And sometimes you keep forever if you get something really good.
Yeah.
But
No,
it's rare.
Yeah.
It's
no,
rare.
Agreed.
Yeah.
Cool. I think we've spent our time. It's been great talking to
man.
you, man. I think
Totally.
we've learned a lot. That's
Yeah,
excellent.
I enjoyed it.
Yeah, me too. And let's do it again soon.
Yeah, definitely.
All right. Awesome.
Definitely.
Thanks, man.